just transitioning away from the short squeeze topic now, I wanted to also address for our viewers how to be defensive in the stock market when you see that it's going down. So um, one of the easiest ways to be defensive is obviously to stay in a larger cash position. Personally, I have shifted to 50% cash, just so that I can use it to dollar cost average in case these stocks continue to go down. But if that's not something you want to do, I personally recommend shifting more into more value investments rather than the speculative market. So the value investments being something like a Johnson & Johnson, a Procter & Gamble, even Berkshire Hathaway. Like that's basically his entire portfolio is value stocks, but it's almost like an ETF. And by that same token, you can just go into more and more ETFs just so that you can continue to have sector exposure if you want. Like if you wanted like the cannabis sector, I've already recommended HMMJ as one.
Yep.
If you want to stay in the tech side of things, like there's also tech ETFs that map the NASDAQ.
Yep.
And then obviously the S&P ETF. So like if you do think the stocks are going to bounce back, maybe you can shift into these value plays or the ETFs. And then, like I said, the cash position's always helpful because as the stock continues to go down, if you're highly convicted on it, you can still get in at good prices, right? Like I don't think Johnson & Johnson's ever going to go down. So if you do get it at a cheaper price, it always makes sense to have cash on the sidelines ready to deploy, right? And the same goes for tech. I mean, I feel like the tech stocks were in general overextended. So if you have a chance to get Apple on a 20-30% correction, which is going to be crazy, but if it does happen, it's always a good idea to have cash to deploy in those situations. I mentioned briefly shifting away from speculative investments. I know a lot of people are going into penny stocks just to try their luck in a bull environment, right? Like those stocks go up a lot faster than these value plays that I'm mentioning. But conversely, when the stocks pull back, they pull back even harder. So until I see strength in the market again, I would stay away from speculative investments like that. And then lastly, just sizing the stop loss. I talked at length about this last week, so I'm not going to go into that again. If you want to watch that video, always feel free to go back and check it out. But I think now
episode 9. Yep, check it out.
9, yeah. I think the sizing of your position and your stop losses, like you got to set those. If you're down $100, $200, whatever your stop loss is, you make sure that you're following that because you don't know where the bottom is, obviously, right? We didn't know where the bottom was last March. We don't know whether this is going to be similar to that or whether it's just a healthy correction to go higher, right? But in either situation, you should have a stop loss to protect yourself. And if you do want to, just go back to episode 9 and watch that in more detail. And always feel free to send Syed a message or myself a message, and we can clarify that for you further.
Yeah, thank you, Deepak. That was great advice. So moving on now, I saw bond rates rising, and I was wondering, and perhaps our viewers would like to know, what's the impact of that on the stock market?
Yeah, so that's a great question. So what happened really is that for the last little while, we've had crazy low rates, right? And the bond prices were falling. It was really good because investors were looking at the interest rates. They're like, okay, instead of going into bonds, let's buy more stocks because we're going to earn a better return on our investment.
Yep.
But slowly but surely, and this was to be expected, the rates continue rising. So as the rates continue rising, investors probably look at shifting some of their portfolio into bonds again, which can be looked at as more safer investments. And as money leaves the stock market and goes into the bonds, obviously the stock suffers. So that's an element of it. The other element of it is, and then this is why you see the NASDAQ being affected more, is that these hyper growth stocks, which aren't necessarily profitable today, the reason why their valuations are going up is because of lower interest rates. And from a mathematical standpoint, when you have lower interest rates to discount your present value, the prices are going to fall when you discount it to the present. So that's how the stock price is going to be pricing in these rising interest rates. So initially, investors were expecting these interest rates, I guess, to stay lower a little bit longer. But as they continue to rise now, it's affecting how these valuations are being priced in. So I think it's a combination of both, which is starting to lead into the decline in stock prices.
Oh, interesting stuff. Okay, yeah, that clears it up a lot on my end, and I'm sure that's great insight for our viewers. Thank you for that, Deepak.